Are you wondering how to start investing in stocks? Well, you're in the right place. Learning how to invest in stocks doesn't have to be hard. In fact, it can be quite simple. So in today's video, we're going to help you learn not only how to get started, but we're also going to help you understand why stock investing is one of the most powerful tools for generating wealth over time. We're also going to help you understand when is the best time to buy stocks, what kind of stocks we want to be looking for, and also one of the big questions a lot of new investors have is, well, what if? Because we all know that trading and investing does involve risk, but if you know what you're doing, it doesn't have to be scary. So stay tuned, because by the end of this video, you're going to have a very clear understanding of the hows, what, when, wheres, and whys, and even the what ifs, and you'll be ready to make your first investment with confidence. So stay tuned. So whether you're just getting started or you've been thinking about investing for a while now, you probably already have a pretty good idea that investing in stocks for the long run is one of the most powerful tools for generating wealth over time. So whether you're looking to invest and save for retirement, or you're wanting to create some financial security for yourself by building your nest egg, or maybe you're even looking to create generational wealth to pass on to your children to help set them up for life, you can do that. You can even use stocks, investing in stocks, to generate passive income through dividends and learning how to use strategies like covered calls, which we'll talk about. So regardless of where you're coming from, what kind of experience or knowledge or education you have, you can learn this. In fact, anybody can learn the strategies we're going to help you cover today in this video. By the end of this video, again, you'll have more confidence in your ability to go pick a stock and make that investment and get things started for you today so you can start taking control of your financial future. My name is Noah Davidson, and over the past 25 years, I have helped tens of thousands of people learn how to invest. And I've helped all kinds of people just like you from all kinds of backgrounds, all different age groups, all different education levels, and all different amounts of money get started and go from not knowing what they're doing and not having a game plan to knowing what they're doing and having a game plan and a plan of action for them to follow to help them make those investment decisions with more confidence. And if you stick around to the end of this video, not only will you get that beginner's guide on how to start investing in stocks, I'll give you some of my favorite stock picks for income and cash flow, some handsome dividend payers, as well as some growth candidates for us to consider. Now, if you're just getting started and you have no idea what stocks are or how the markets work, hold on one second. What I have here are a bunch of old-timey stock certificates. I got some General Motors stock. I got some Norwich Pharmaceutical Company. I got some Polymer Corporation. I mean, these are all, Pan Am stock. These are all stocks that are now defunct, but these are actual stock certificates. And if you've never seen a stock certificate, it's kind of fun. Each one of these certificates is one share of ownership in a company. And again, now in the modern market, we really don't see stock certificates. I mean, yes, you can get your broker to print them for you and deliver them for you. But the reality of it is we're doing everything digitally. So, hey, well, that took me a minute to clean up. I got another example for you to help you understand the concept. Check this out. I've got a cool little Jack in the Box. Now, this Jack in the Box is our Cashflow Academy unofficial mascot. And we use this to help us represent what stock ownership is like. So if you're interested in buying a share of a company, buying into the company, you are investing in the company, and then they can take that investment money and use that to grow their business. Rather than going to a bank and borrowing the money, a company will go public and issue those shares to the public in exchange for those investment dollars in hopes that they can produce profits. Now, one share of the stock. We like this company. We think it's got a bright future. We like their products, and we do some analysis on it. We're going to do what's called some fundamental analysis on it. And what we discover is that this company is fundamentally sound. They've got good leadership. They've got a really clean balance sheet. We can learn everything there is to know about fundamental analysis to help us know the health of the company. And then we can do what's called technical analysis. Now, technical analysis is the study of price, and we can learn to identify price levels, important price levels where people buy the stock. We can identify areas where people tend to sell the stock. We can identify trends. One of the things you'll learn about investing is we love a stock that trends and goes up in value. That's one of the things we're looking for. But at the end of the day, price is what you pay. It's the value of the company that you get. And so we care less about the price than we do about the value of the stock. Warren Buffett once said, I'd rather buy a wonderful company at a fair price than a fair company at a wonderful price. So what we're looking for is value here. Now, the company, this Jack in the Box, has a little crank on it. And when you crank that wheel, that represents the company doing the work, producing the products, producing the services, and generating income. Hopefully they're generating profits. Now, some companies will share in those profits with the investors. They will pay what's called a dividend. You can imagine them dividing the profits up, dividing them up and sharing them with the shareholders. Simple stuff, right? So we understand that. And whether we're looking for stocks that go up in value where we can buy low and sell high, or we're looking for a company that produces consistent cash flow and dividends, well, we love those kinds of companies. So there's different strategies and different ways of thinking. One of my favorite things for investing is finding a blue chip, a solid, sound company. These are all companies you've known about, you've heard of. They're big companies that are really profitable, and they pay quarterly dividends. And when they crank that wheel, they do all the work for us. I mean, they crank that wheel, they do all the work. The money they produce, the profits they produce, they share with us, and we get that dividend payout every quarter. And that's passive income. Now, we also can look for stocks that we think have growth potential. Stocks that maybe are expanding or building new products or delivering new services. And if it's a company that's growing that we think has big upside potential, we can worry about the price. We can buy it and believe that the stock value will go up over time. And there's, some people will say you buy a stock and you hold it forever. I would go as far as to say, if you buy a stock, you probably want to be at least willing to hold it for 2 to 5 years at a minimum, and maybe for the long haul. Maybe it's the type of company you never, ever want to sell. I once upon a time had a student who, great story, his parents, well, actually, I take that back. His grandparents invested in shares of stocks for him when he was a child. So when he was a little baby, when he was 1 year old, his grandparents bought him shares of a $1 stock. He bought them one share of a $1 stock. And then when he was 2 years old, they bought him, I take that back, it was 200 shares of a $2 stock. And when he was 3 years old, they bought him 300 shares of a $3 stock. And they did this up until he was a teenager and he graduated from high school. But the stock they bought for him when he was 2 years old, he still owns today. And when I met this gentleman, he was in his 70s. And he was living on the cash flow that stock his grandparents bought for him when he was 2 years old. And it was such a great story because the company his grandparents invested in for him was Walmart. And to this day, Walmart continues to grow, continues to expand, continues to control markets, and they continue to pay a dividend. Now, that's just an example of how long-term investment can generate long-term gains, long-term income, long-term cash flow. So this is a fun example. And again, we're going to talk about other things, but when you find a company you like that you want to invest in, you're looking for that cash flow, that income, cash flow, profits. And again, price is what you pay, but it's the value what you get. So you're going to do fundamental analysis. You're going to do some technical analysis and chart reading. We'll do a little bit of risk management so we understand what kind of risk is involved. And then we'll talk about where the cash flow comes in. Is it a growth stock where we're looking for the price to go up in value? Is it an income producing stock that pays us a dividend? Or is it the kind of stock that we can own and sell options on, like covered calls, where we can generate additional passive income for ourselves by owning that asset? Now, before you start investing or before you are ready to invest, it's wise to make sure you have at least 3 to 6 months worth of emergency cash reserves just to make sure that you've got your basics covered. Now that you've got that, again, you're ready to invest. And if you don't have a brokerage account open yet, you're going to want to get a great brokerage account to work with. Now, there's lots and lots of great brokers out there and all kinds of options to choose from. You got the Robin Hoods of the world, you got the Charles Schwabs of the world, you got the Fidelities, you got the E-Trades. I mean, there's a ton of brokers brokers out there. It's a highly competitive industry. And one of the things you're looking for, in my opinion, what you should be looking for is, one, you want to make sure it's a solid company with a solid track record that's been around. Two, that they're FDIC insured or FINRA insured so that your deposits can be insured if the company were to run into trouble. And then I like to look for the brokerages that have low to no cost commissions, no cost commission on stocks, of course, low cost commission on options if you choose to trade options. And then the other thing I like to look for is, do they have great customer service? Somebody to help you if you need it, when you need help making an order to buy or making an order to sell. And do they have a platform? And so I like the platforms that, I can work on my smartphone, my desktop, my laptop, so I can access my investment accounts from anywhere at the click of a button. Anywhere I've got Wi-Fi or cellular, I can access my accounts. So once you get those things covered, you're ready to start investing. And one last thing to consider: look for a brokerage account that allows you to paper trade, to practice investing and trading in a virtual account with pretend money, so you can practice the buying and selling process and learn how to do it without risking real money, so that you can feel more confident when you actually go to pull the trigger when you're ready to invest for real. Okay, so those are the things we're going to look for. Now let's change scenes. Now over at the Cashflow Academy, we have a system we use to help us select better investments, to qualify our candidates. And we run every analysis we do through what we call the 4 pillars. Now our 4 pillars, we've mentioned a couple of them already. Our fundamental analysis, we're looking for the health, general strength of the company on the books. We're looking at their fundamental analysis. We're also going to look at their technical analysis, where we learn to read the charts, we learn to read the personality of the stock, we learn to read the trends, and that can help us time when to buy and sell. So fundamental analysis helps us know what to buy. Technical analysis helps us know when to buy. Then we use what we call the cash flow pillar. Now the cash flow pillar is going to be how we generate the income, how we generate the cash flow. Now, if we're investing for the long term, we can invest in blue chip dividend paying type stocks and look for that slow and steady income, kind of 5% dividends. We can probably augment that. That's annually, 5% annually. We can probably augment that learning how to write covered calls and sell cash secured puts and option strategies that can help generate more income up above and beyond. And we can shoot for higher gains with consistently, no matter what the market's doing, up, down, or sideways, we can generate that income. Or we can also look for those growth companies where we expect the prices to go up over time. Now, the more time you plan on owning a stock, the more important fundamental analysis is. Again, the longer term we plan on owning the stock, the more important that fundamental analysis is. We also have what we call the risk management pillar to help us understand what to do if the market were to go south or the stock price were to go down. We learn how to protect our asset. We learn how to do things like cost averaging the stock. We learn how to buy protective put options like insurance on the assets we own. Did you know you could do that? You can buy insurance on the stocks you buy, which can help you sleep at night more soundly, which is pretty cool. So that being said, I'm going to take a minute and just give you a really quick crash course and see how simple it can be for you to learn how to invest, how to start investing with your own money, and again, to do so with a little bit more confidence. So here we go. So the 4 pillars of investing are how we go about identifying opportunities and selecting the right kinds of stocks for ourselves. And as we've been talking about, the fundamental analysis is really the what. It's the what we're going to invest in and the why. So it's a what and a why question. Like, why do I like this company? Why do I think that they have growth potential? And what we do is we look at the company's balance sheet. And so every company has a balance sheet, and a balance sheet isn't that complicated of a concept. Learning how to read a balance sheet takes time and study and effort, but a balance sheet at the end of the day has income, money that the company produces, and they have expenses, money that the company spends on things. And then they also have assets and liabilities. And so we have an asset column, which are the things that make an investor happy. And then they have a liability column, which is some of the things that maybe give an investor concern, like the company might be carrying a lot of debt or have other expenditures out there and things of that nature. So what we're looking for is assets that produce income to cover the expenses and low liabilities that give us a fundamentally sound company that we're going to look for. And we'll give you a quick example of that in a moment. The technical analysis is the when. When do we buy? When do we sell? And we can find stocks that are trending up and that can make an investor happy. And we can find stocks that are stagnant and sideways and generate income through dividends and things like that. And that can make us happy. And we can even find opportunities to buy stocks when they go down and they're all on sale. And that's actually something we're going to learn to love. So we can be happy when a stock goes up, down, or sideways as long as we know how to manage the risk. And so we also have two more pillars. And again, cash flow is how we're going to make our money. Are we going to pick a stock that pays a dividend? Are we going to focus on an income generating strategy like covered calls? And again, if you're new to that concept and you don't know the first thing about options, that's okay. What I would like for you now to have is just an awareness that there's this thing called a covered call. And a covered call is just an options contract on the stock you own that can generate some income, which is pretty cool. And we can also learn how to protect ourselves. Risk management is another thing that's really important to us, where we can own the stock and we can protect it by buying some insurance. And the way we purchase insurance on stocks, it's called a protective put, okay? And a protective put is a contract that gives us the right to sell the stock at a predetermined price so we can protect ourselves. So whether the market's going up, down, or sideways, we can have a happy temperament regardless of which way the markets are going, which again, if the market goes up, we'll be happy because we got nice capital gains. If the market's going sideways, we'll be happy because we have some cash flow, some dividends, some covered calls. And if the market's going down, we're going to be happy because we know how to cover our own assets, we know how to protect ourselves, and we know how to buy things when they go on sale, which is a really cool concept. We love a down market because that's the best time to buy things. And so we'll look at some charts and talk about those things here in a moment. But you get the picture. Up, down, or sideways, we're going to be happy. And one of the most important things about learning how and starting investing in stocks is going in and learning how to develop the right temperament. Okay, so there is no magic way to pick stocks. What we're looking for is criteria that matches the type of investment strategy we're looking for. So imagine for a moment, I was looking for growth stocks. We're looking for stocks that we think can go up over time. And maybe we're interested in companies that are producing technology that's related to AI because there's a big boom and interest in AI right now. I could do really simple things like go look up the top 10 AI stocks out there and then do some fundamental research on them and find the one that has the best growth potential according to the criteria I'm looking for. Now, again, the more I know about fundamental analysis, the better off I'm going to be. Let's say, for example, I was interested in NVIDIA or Apple or Microsoft or any other of the top AI companies. Let's just take NVIDIA, for example. So I'm going to pop open a chart of NVIDIA here. And NVIDIA has been on a tear. Their stock has recently been split 10 for 1, which means that the stock was really, really expensive, up over $1,000 a share. But they split the shares 10 for 1. So if you had one share, you now own 10 shares at 1/10 of the price. If you had 100 shares, you now own 1,000 shares at 1/10 the price. And the stock's going for just about $115 per share at the moment. Now, there's all kinds of potential upside reward here. There might also be some downside risk here. But we could buy that asset right now. I could buy 1 share, 2 shares, 10 shares, 100 shares, 1,000 shares. I get to choose exactly how many shares I want to invest. And I could do something really, really simple like dollar cost average over time. Say, I am all in on NVIDIA, or I'm all in on Apple, or I'm all in on Microsoft, or I believe in whatever the company is. There's lots of great companies to choose from. One of the tricks is to stick mainstream and to invest in companies that you know that are really, really popular, that are really, really liquid. You don't need to look for the needle in the haystack. You just look for the best candidates out there. And of course, you could always just invest in the S&P 500. We got another video for that. If you want to go watch that, you can find it. Now, let's say I think the stock's going to go up and I want to buy it. So I could go in and click the buy button and select 1 share, 2 shares, 10 shares, 100 shares, doesn't matter. I can buy that, or I could have money put into my brokerage account each month on a direct deposit, or, where we auto fund the brokerage account, and I could have that do auto purchasing for me where I consistently buy shares over time. And, I might pay $115 a share right now. I might pay $100 a share in a week. I might pay $80 a share in 2 weeks. The stock price is going down, but I'm buying more. Or I could end up paying $140 a share, $150 a share, $170 a share, all over the place. I'm averaging my cost out over time. And what I'm relying on is NVIDIA stock price growing over the next 10 years, over the next 20 years, over the next 30 years, depending on what your time frame is, what your goals are. The upside potential's unlimited, again, as long as you're selecting the stock and you understand the risk. Now, there are things we can do to control the risk. We can buy insurance. To do that, we have to own 100 share increments of the stock because option contracts are for 100 shares each. So that would be, again, like a growth strategy. And sometimes the stock pays a dividend, like NVIDIA just started paying a tiny dividend, a penny per share. Microsoft pays a minor dividend. Apple started to pay a dividend. Not big dividend payers, but they are big players. Now, maybe you're interested in other sectors of the economy. Maybe you're interested in healthcare. Maybe you're interested in a company like Novo Nordisk, NVO. They make that new drug, wonder drug Ozempic that all your favorite celebrities are taking. And it's going for about $135 a share. And they pay a modest dividend. Looks like they've got a dividend over the last several quarters where they're paying a 92-cent dividend, 51-cent dividend. It's kind of all over the place. But they do pay a dividend, and you could own that asset. And again, you could buy 1 share, 2 shares, 10 shares, 100 shares, thousands of shares, whatever you want. You could cost average in over time. And again, if your time frame is long enough, the market over time tends to go up. Bull markets can last for decades, and bear markets tend to last 18 months or so, maybe 2 years on the high end, but it's usually like between 6 to 18 months for a recession and a bear market. But then over the long haul, markets go up over time. So you don't need to necessarily time the market perfectly, but you can have long-term exposure to the upside. Another strategy for your consideration is to go for the blue chip. We mentioned this. You go for the blue chip, the dividend payer, and you could think of some companies you might want to own, and you can find out if they pay a dividend. You could literally Google top 10 dividend paying stocks, and you could get a list. In fact, I just did that, and here are some of the stocks that came up. A couple of them that popped up on my radar were stocks like 3M. I'm sure you've heard of 3M. They make Post-it notes, and they have a stock price right now that is going for about $135 a share. They're paying a 78 dividend, $1.50 dividend, $1.50 dividend, $1.58 dividend. They've been paying a handsome dividend. They just spun off one of their branches, and so they're one of the aspects of their business elsewhere. But it's a healthy company. Strong fundamentals, pays a dividend, and it's currently going for $135 a share. Again, you can cost average over time. It pays a dividend, and that's passive income that you're going to collect every quarter. And looks like right now that stock's paying a pretty decent little dividend. It's paying somewhere around 6.4% annually. That might be a little bit different now that they've spun off the Solventium is the other part of their company. They spun off a little healthcare division that they spun off. But maybe that's the candidate you find. Or Exxon Mobil or Chevron, for example. Maybe you gas up your car at Chevron, and Chevron's been around forever, and they're going to be around forever. Petroleum products are not going anywhere. And this stock price has been as high as 70 in recent months, and it's currently down here about $140 per share on sale. They pay about a 4% dividend. They've had a tremendous track record of paying dividends, and you could own that asset. The stock price can go up, down, and sideways. We don't care. That dividend comes in like clockwork. And you can, and this, type of candidate is paying about 4%, just shy of 4% annual yield. Plus you can learn to use cash flow strategies like covered calls. I got one more example for you. Again, these are just ideas and not recommendations to buy or sell. But another stock that's out there that's pretty popular, Dow Chemical, pays a dividend. It's been as high as $70 a share and as low as $25 a share over the last couple years. At right now, it's at $50 a share. They pay a 70-cent dividend, so that's over 5% annually. And just to do some math here, just to kind of help you understand it, I'm going to give you a concept here. Again, the stock market on average returns about 11%, 10%, somewhere in that ballpark over the last 100 years. And some years are better and some years are worse. And you get paid for the performance of the stock, and people are happy when it goes up and they're not that happy when it goes down. But over the long run, markets go up. If you're investing in companies you like and you're hoping to beat the market averages, that's where you can look for the top leaders in the industry and top stocks and stuff like that, the biggest growth stocks. And you can try your hand at trying to do the stock picking. But again, if you're picking great companies, fundamentally sound companies, you're going to do fine over the long run. Now, this is a cash flow strategy that doesn't matter whether the market goes up, down, or sideways. I just want you to do the math. You don't have to understand everything here, but you want to understand the concept. We could buy the stock at $50 a share. They pay a 70-cent dividend. So 70 cents times 4 quarters. So over 4 quarters in a year, you're going to collect $2.80 of income on your $50 investment. So divided by $50 per share, assuming that's the price we purchase it at, you'd be pulling in about 0.0056 times 100 shares times 100%, 5.6% annually. And then we could take that same stock and we could learn to write covered calls, and we can also, of course, buy protective puts to cover the asset. But we could turn around, and just to give you an example of what's possible, the market can go up, down, or sideways. This company's going to pay a dividend. Okay, they've been paying a dividend for a long time with a great track record. I could go sell about a 2-month covered call, and I'm using current market examples to show you this. I could buy the stock at 50, promise to sell it out at 55. They'd pay me about 56 cents per share. Let's call it 55 cents just to make the math simple. And let's say we collect another 55 cents, and that's for a 2-month option times 6 times a year. So we can do that 12 months in a year. So times 6, we're collecting another $3.30 on top of the $2.80 we're collecting in the dividend. Now, it's not going to be the same every time, but I just used a current market example to show you what's possible. So let's imagine we're collecting about $6.10 per year of passive income by the dividend and the covered call, which is a conservative investment strategy. And we're now beating 11%. We're actually right up there with market averages. It doesn't matter if the market has a good year. It doesn't matter if the market goes up. It doesn't matter if the market goes down. It doesn't matter if the market goes sideways. We can compound our interest over time. And if you understand compounding interest, it is the 8th wonder of the world. Let's take a better look at that. Again, compounding interest is the 8th wonder of the world. And if you can understand this concept and you can implement it for yourself, you can make untold riches over time. The secret ingredient is time. So whether you're young or you're old, you can do this. Now watch this. I'm going to open up a compound interest calculator. I just Googled compound interest calculator, and this little investor.gov is one of the first ones that pops up. And I want you to imagine for a moment you're starting out with a modest investment. Let's say you got a couple of $1,000. Let's say you got a $10,000 little nest egg you've been socking away, and you've got that little investment. And let's say you are able to save and add an additional $500 a month. Okay, so $500 a month. All right. Okay, and let's say maybe you're young, maybe you're old. Let's say you're in your 20s, or maybe you're in your 30s. But let's say you've got the next 30 years to invest over time. And let's imagine that we take that example I just gave you on Dow, where we own the stock, we collect the dividend, and we learn to write covered calls, and we average somewhere around 10, 11, 12, 13. Sometimes on a good year you can do 14, 15%, but it varies. It's a little bit all over the place, so we're going to put in a variance here. But let's say we did about that 12% ballpark, okay? So by the time we added up the dividend and the covered calls, and there's other things we can do to generate even more income on that. But let's say we got about a 12% annual return, and that's not far off market averages. And then we'll put in an interest rate variance of plus or minus 2%. So some years are better, some years are worse. And we say we compound that annually, and we calculate, okay? Now, that will make you a multi-millionaire. I mean, that'll give you over the next 30 years your $10,000 investment, plus your extra $500 a month, and maybe you do more, maybe you do less. But if you can get that market average of 10, 11, 12% over the next 30 years, you've turned that into $1.747 million. And if you get the 2% better because you learned how to write covered calls and you spent time with people like me, with like Andy Tanner, with Corey Holiday, and you learned how to do some of the things we do, that could be $2.6 million. You know, if it's a 2% variance less, maybe you're only coming away with $1.1 million. But imagine that you increase your income bracket over time, and maybe you're a little bit more disciplined, and maybe you sock away $1,000 a month, and you start out with that same $10,000 investment, and you put $10,000 in, and then you add $1,000 a month, and you compound it over 30 years at 12% plus or minus 2%. Calculate that out, and you're at $3.195 million. On the high end, you're actually up at $4.7 million, and on the low end, you're at 2.1. That is the power of compounding interest. Now, again, if you're young and you have all the time in the world, like, this is perfect. Like, I've got young daughters, I've got a son, I've been teaching them this, and they get the concept. It's incredibly powerful, and they've started investing in their youth. If you're a little bit further along in life, that what you want to learn how to do is how to accelerate that compounding. There are strategies that we can use that seek higher yield, a little bit more risk, a little bit more reward, but you can learn to invest with what is called asymmetrical risk reward, where we can do things to limit the downside risk, but really ramp up the upside potential using options and things of that nature. Where, again, investing doesn't have to be hard. It doesn't have to be complicated, but you need to start doing it. And you like the idea of some of the strategies you heard here today, and you had fun watching this video, and we made it entertaining for you, we'd love to spend more time for you. Click that like button, click the subscribe button, do all those things you do, follow us, and you can hang out with us every time we put out a new video. And again, the Cashflow Academy, this is what we do. We teach people just like you how to invest more intelligently, how to develop a good investor temperament, how to manage your own money so you're not paying somebody else and they're getting a piece of the action. You're getting all that action for yourself, optimizing your gains, learning how to maximize those returns, learning how to control the risk so you can sleep at night without any fear. There is no fear when you learn how to do this. Knowledge is power. Inaction will rob you blind. Again, click that like button, click the subscribe button, smash the bell, whatever it is you do, and we'd love to spend more time with you teaching you the ways of the Wall Street investor. Dude, that was awesome. That was a lot of fun. I enjoyed talking with you. If you want to continue learning more about this, now that you've got a really good basic understanding of how to invest in stocks and some of the concepts that we talk about as investors, another great video to watch would be our stock on how to select blue chip stocks. You can click on that video here. Blue chip stocks are just like the example we gave you. Again, they are the types of stocks that pay dividends, that have a wide variety of products. They're companies you know. They're companies you use their products of. We're talking about the Coca-Colas of the world. We're talking about the Chevrons, the Exxon Mobils, the Dow Chemicals, these big blue chip companies, Verizon, IBM. I mean, you name it. There's companies that have been around for a long time that pay dividends, have options, are ideal for the cash flow strategies and the compounding strategies we just talked about. So click on this video here and learn more about investing in blue chip stocks.